Hey guys, welcome to another video brought to you by Total Control Traders. Here is part 2 of Ultimate Crash Course for beginners and those looking to start. Now in the last video, in the part 1, there were teasers and quick tips. We kept it short, and in this video we're going into much more in depth on each of the topics, along with 2 new topics. So expect a longer video comparing to the part 1. Now there are lots of videos out there titled the #1 trading indicator. However, personally I feel that there isn't just one single indicator that can trump all. It's more so a matter of combining all those indicators that work for you and making sure that you're keeping consistent. As mentioned in the last video, with each indicator, it'll take time for you to get used to. It'll take time for you to figure out. And then it'll also take time for you to find how does it interact with other indicators. How do you use it to your advantage? So make sure you find your edge before you start playing with size. And what that means is make sure you're developing a consistent winning percentage before you start putting more of your portfolio size into day trading portion. And that's going to be one of the topics today. So we'll get into it. One last thing I want to mention before we dive deeper into it is successful traders, majority of them start with passion and persistence, which then in time leads into knowledge that gives them an advantage. If you haven't already done so, make sure you check out our website at totalcontroltraders.com. That's total.controltraders.com. And we will be offering a free trial period, 7-day trial period to our trading chat room for 2 days only on Sunday, the 24th, I believe it is. Yeah, Sunday the 24th, and then the following Monday the 25th. So keep an eye out for that. All right, let's get into it. First topic, indicators. In the last video we briefly discussed trading psychology. I've decided to leave that topic out of this video because trading psychology is by far one of the most important, if not the most important, to master. Thus the name of our group, Total Control Traders. You want to be in control, and psychology is a big part of it. So that there will be a separate video on that topic alone. Now if I were to pick out top three indicators, as mentioned, there's not one single indicator that can trump all. If I were to pick out 3, first, a must-have is volume. So these sticks down here are volumes. And what is volume and how does it help you? So volume is shares traded in that specific time frame that you're looking at. In this case, I'm looking at the hourly, and this is a live chart, so SPX is moving right now, just rejecting from the hourly 8 we can see. Second one being the hourly 8, or the 8 EMA, exponential moving average. There's lots of different ones that people use. There's 8, 12, 26, 50, 100. Just depending on what kind of trader you are, whether if you're an extra long trader or extra short, then you want to increase that EMA number. I personally enjoy using the 8 EMA just because on any time frame it works fairly well. Sometimes you want to check out the 12 or 20, 26, but most cases charts seem to react to 8 very well, as we can see here. Reject, reject. And not last but not least, one of the oscillators. for me, I use the RSI, and let's pull that up. RSI, Relative Strength Index, I believe that's what it stands for. A lot of people choose to use the MACD or also use the MACD, which is similar but also tells you the momentum of where the chart's going. What I found from it personally is the MACD tends to be a laggard indicator. It's more so used as a confirmation, so doesn't help me as a day trader as much. It would definitely help you if you are just beginning to trade, or you are still on the beginner phase. So let's pull that up, take a look at what it looks like. MACD. There we go. Alright, so with the MACD, you can see that from here, the blue line had crossed over the orange line. I can't remember the exact term, so each of these colors, but generally there's one line that's used as a base, another line that's used as a momentum indicator. So as the blue line crosses the orange line, you will see that this is now, the momentum is now trending to the bears. However, if you look at the time that it crossed, on the chart alone, on the RSI, it doesn't say much. So sometimes you can use it as leading for sure, but it's not that accurate. So if you look at here, it crossed over, indicating, all right, the chart might be going into a downward momentum. However, we sort of just traded sideways for the longest time. It's a very good indicator to use, don't get me wrong. The orange line basically represents RSI in a way, but more rounded out. And then the blue line is just like an additional data. So choose an oscillator, and that will help you in determining some chart patterns that we're going to discuss, which requires more than one single indicator. All right. Back to the first one, volume. Why is volume the most important indicator? How does it tell the psychology behind trading? So volume indicates buying or selling pressure, in the sense that if you see a spike in volume here, there were a lot of people rushing to get out. Now this is a opening candle, but it does outweigh other opening candles. If you, vice versa, if you see a spike in bull volume, let's try to find one here. If you see a spike in bull volume, people are rushing to get in. And you can see that there's generally follow through. So from the candle that we had on Friday, we're likely to see somewhat of a follow through. And then with oscillators, we covered that it covers momentum, divergences, which is a chart pattern that we'll go into, and EMA shows strength and weakness. So with EMA's exponential moving average, if you're trading down below the EMA, chart is relatively weak. You can see that we keep rejecting from the 8 on the hourly. So as long as we remain under the 8 EMA, or in my particular case, I use the 8. As long as we remain under the EMA that you're choosing to use, chart is relatively weak. We're basically going to be rejecting here again if the price goes down further. One other thing you got to understand about EMA is, as the price moves, the EMA gets dragged in that direction. So if we're looking at here, because the price went up, the EMA went up, and then the price went up further, and because it's crossed over the EMA by a more substantial amount now, the price moved further up. Okay, And that's it for indicators. Just gonna cover 3 on this round of video, this part 2, as there are lots of topics to cover. Second topic, tools. All right, tools are, I don't think, yeah, I'm gonna move it over. So tools are these things, what you use to draw, what you use to just put any drawings on the chart, basically. Anything you like. Now I use TradingView personally, and just because I find it's a very easy to use HTML based website that can't get any cleaner. You know, it's extremely customizable. Any tools that you like, you can favorite it, and then it just pops up a favorite bar like this where you can put anywhere. And I put on the bottom so that it's not in the chart. Tools is arguably more important than indicators, because indicators are there to help you, but tools, you need to develop the skills on using it to find the right pattern. And ideally you want to be able to eyeball what the trend looks like on the first glance on a longer time frame, and tools will help you with that too. So with tools, it not only helps you identify the patterns, visualize what's going on, but it also helps you measure when you're doing comparisons. So for example, if I'm comparing this move, I can easily measure that it was a 1.07% move on a 15-hour trading. And similar idea, coming down, 2% drop on 36 trading hours. So tools are there to help, and it takes skills to. That was one of the simplest tools, so that one doesn't take any skills. But if you're looking at drawing a trend line or a wedge, a bull flag, things that help you identify the pattern, those take practice. Make sure you take the time to develop the skills that's necessary, and my videos here are to help you doing that. Now, one thing that a lot of beginner traders tend to do is trading via support and resistance, as it was mentioned in the part 1 video. But there is a fundamental problem with that, in the sense that market makers are the ones who are dictating the market. So let's say that you're in the trade, you can clearly see that from this move down, support is right here. All right, you get in here, you're basically just trying to make some money with the uptrend, then boom, it wicks down below, quickly get bought up. You would have been stopped out here. So same idea if you were to play it the other way. If you're looking for a downward movement, what would be a good somewhere? Okay, yeah. So similar idea. If you're looking for a downward movement, so then you enter somewhere here and you put a stop here. Now you forgot to sell on this one. We came back up. You would have been stopped out. Then all these other time you could have been in the money, making money, instead of getting stopped out so quickly here. So there is a fundamental problem with trading versus using support and resistance versus identifying the trend and patterns, because this actually would be a classic example. 1, 2, 3, maybe not, but all right, this, you want to identify the pattern. The idea of this is then you draw a trend line where majority you can see lots of resistances and supports, instead of using a support and resistance line. Okay. With this, you can clearly see there's been rejections off of this trend line until over here, this slight break of 80 MA on low bull volume. That's when you use the combination of other indicators to determine whether this is going to be a true break. It was a spinning top candlestick on low bull volume, so I wouldn't trust this break, and you can see that we rejected off of it right after. Trend lines tend to be a lot more helpful versus simply using support and resistance lines. If you were to use support and resistance lines, as some of you may have seen from my market videos, try to draw a zone instead. So with this particular one, this part makes sense. Following this part would make sense too. Yeah. Now you can say that it gives you not as a precise price movement action wise. You know, you could be looking at losing more money or losing more profits that you're already in. However, it does give you a lot more certainty. If you look at this zone, there's been multiple reject, support, 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 somewhat of a support, then break down under, and then reject again. Sideways action, you can clearly see wicks going in between the two zones. Then we broke down under, came back, reject from the zone again. This, using a zone, I find a lot more helpful in the sense that when you look at any of these movements, let's say that the price is right here on this candle right now. It helps you withstand that as long as this bottom zone hold, you're okay to hold. So you know that there's going to be strong resistance support in this zone. Now, when we broke here, I actually think I mentioned this on Friday's video. And then when we broke here, that's the red flag for exit. So big difference on using one single line versus a zone or trend lines. Alright, that's it for tools. Next topic is trends. What are trends? Let's go to a longer time frame. And we'll go back to the shorter ones so that you can, once you learn to identify trends in the longer time frames, it becomes easier in the shorter time frames because shorter time frames tend to be a lot choppier than the longer time frames when you're looking for trends. If you look at this, we have been in an upward trend, and trend basically means like this. So as long as we're making higher highs, higher lows, higher high, higher low, this is in an upward trend. Very clear upward trend. Until this part where lower high, yet we still made a higher low. Then following with a higher high. So trend is intact even though they had a potential of rejecting here or reversal here. Same vice versa. Oh, wrong tool. If you're seeing a chart like this, okay, it's a bit harder to draw now. Right, this is a clear downward trend. Until here, there was a reversal, but every now and then you will see substantial drop, negating the reversal, continuing with the trend. So it is extremely important to be able to identify the trend, whether you're using tools or not. Ideally, you'll be able to visually identify the trend by first looking at it. This right here is a very clear trend. This area right here, this is a very clear trend, upward trend. This area right here, no clear trend. Chop, up, down, up, down, up. So then when we made the higher low here, that was the confirmation of trend going bull. This is easy money. This is hard money. And that's why there's different kinds of patiences. You know, patience pays, but there are different patience where whether if you want to be patient in your trade or if you want to be patient and greedy. Sometimes it justifies for you to be patiently greedy versus patiently waiting for that reversal. Big difference, guys. This right now could potentially be a reversal. Not the time to be patiently greedy. Be very agile on your trades. All right, next is patterns. Patterns, there are, first one I want to bring up would be divergences. You guys probably have heard me referring to it multiple times if you've been watching my market videos. Let me bring up the reference chart. So this is a reference chart, a cheat sheet basically for what divergences are. Divergences is, I've only became familiar with it probably a few months ago. And again, my trading journey is not anywhere by far the most tenure or most experienced or most profitable versus some other people out there. I'm gonna be honest, you know, it's more so about finding that consistency, and everyone in the community is learning together. That's what makes me most proud of, where everyone is learning, and the things that I have been through, hopefully by these videos, will help you avoid the mistakes that I have made. Trade with divergences will help you make so much more money. A lot of times you will see a chart, and this is why people get faked out, beginner traders get faked out. You will see a higher high, a higher low, then people are thinking, you know, it's gonna go down, but instead it makes a higher higher again, then all of a sudden it makes a lower low. That's because of a divergence. This is your RSI, your MACD, your oscillators. This is your price movement. Okay, so the blue lines are your price movement, the red lines are your oscillators. When this happens, what the psychology stands for behind it is, even though the price is moving up, the oscillators are moving in a opposite trend, meaning that we are the lack of buyers are beginning to show. Although that the price is moving up, buyers are decreasing. This is basically what it means. This is bearish, on the other side is bullish, opposite. Price is moving down, we can clearly see that people want to get in, buyers are increasing. Hidden is a little bit more, I wouldn't say confusing. Hidden is generally you want to look for hiddens in a continuation situation. So if the price was already on the downward momentum and you see a hidden divergence, bear divergence, even though with increasing oscillators, this is, the chart is going to look further down. Same vice versa. In the bullish trend, if you see hidden bullish divergence, price is making higher, lower low, lower high, higher low, with oscillators making lower low, price action is looking up. Exaggerated doesn't tend to work that well. I've tried it a few times. On the price, yeah, I gotta take a look at this one a little bit more. But generally the psychology behind this is unable to break to a new high, double top. This is already a bear signal, regardless of the oscillator. With decreasing, obviously it's gonna be bear, lack of buyers. Vice versa, double bottom, price is already looking up on the double bottom kind of a pattern. With oscillators increasing, that just helps with the price movement upwards. All right, that's it for patterns. Next, sizing. Your trade sizing, extremely crucial topic, and I will be spending some time on this topic, going into in-depth on how you should be sizing your trades, how you should be sizing your portfolios. The first topic is overall sizing. I don't have any slides prepared for this, so just gonna have to stare at me talking. I guess in the meantime, I'll have this pulled up so you can take a screenshot. All right, so with sizing, overall sizing, based on your portfolio, let's say for example, you have 100,000, easy number, okay? Just for the number's sake, so you have 100,000. How much of your portfolio should you be trading with? Well, first question you should be asking yourself, what is your confidence level? Have you found your edge yet? Are you consistently winning? If not, it's okay to start small. Of your 100,000, maybe put 5,000, even 3,000 into a trading account. The rest, put it into something a little bit more conservative, ETF, mutual fund, that's consistently going up. That will help you with your mentality, your psychology of trading. And this is what I mean by proper investment style in my video of how to 100-fold your net worth. Proper investment style is one of the most crucial things when you're looking to rack up your net worth. All right, so start small, 3 to 5%. It's okay. You may say, but I have 100,000. On this trade that I traded with 3,000, I made $100. I could have very well made $1,000 instead. Yes, that's true. But same vice versa. If you don't have that consistency of winning, consistently having decent wins, then when you start getting too overconfident, when you size up, when that cash is there available for you to size up, that one big loss is going to wipe out all your wins. So start small, make sure you get your emotions in control, make sure you get your winning percent up, your return percent up before start sizing up. Second, trade sizing. So of that 100,000, let's say you're a little bit more confident now. You have 10,000, easy number's sake. You have 10,000 in your trading account. How do you determine how much you put into each trade? All right. So let's say out of that 10,000 in your trading account, there are 3 things you want to buy. Then you gotta think, all right, which one are you more confident in buying? Maybe delegate 4,000, 5,000 to that one. The 2 that you're less confident, use less sizing. Then from there, each of those less confidence, for example, you're thinking of 2,500 for each of those trade. Then you also want to divide that particular holding up into 2 or 3 times trade. For beginners, ideally maybe 3 or 4 times even. So each of your entries, you should be looking at 25,000 or 2,500 divided by 3, let's say, you're looking at 800. So then you'd be looking at 3 entries of $800 into that stock. First entry, maybe a little bit smaller. So let's say you go 600 on the first entry, you're not 100% sure yet. Then the stock starts trending in the way that you're looking for. Then you add your second entry. That one can be, say, 1,000, 1,500 kind of thing. Then your last entry would be, most cases, a short-term entry and exit, more like a scalp. That will help you on your trading psychology wise. By doing so, you not only will you be more afraid and exit on the first sign of bear, you will also be more confident. It will also help you with your returns. It'll help you with holding that position to make sure you get the biggest win that you can from this trade. It'll help you hold till that target that you're looking for. Now the hardest part is remembering why you decided to go conservative and keep at it till the target's reached. What I mean by that is, take it for example right now, I've been on a capital preservation mode for a month or so, month and some now, and it's extremely hard to remember why, looking back, why did I go capital preservation, especially when you're seeing a bull chart such as this, just non-stop going up, higher lows, higher high, higher low, higher high. It's hard. But remember, why did you go capital preservation? Why did you become conservative? I'm waiting for that target. I'm waiting for a pullback. It does not mean that I'm not going to be playing bull positions. Play with the trend until it ends. Play with the trend is going to make you easy money. Even though I haven't been making crazy easy money, I'm still making easy money. Until the trend ends, which this could potentially be it. If you look at it closer, let's say 4 hours, you can see that this was a higher low comparing to previous. Higher low, higher high, maybe 8 hours actually. Yeah, higher low, higher high, higher low, lower high. This could be a lower low. Now we're gonna have to see where this goes. So remembering why you went conservative and keeping at it is crucial. That's the real practice of patience. Which brings me to the next topic, emotions. Managing those emotions. The top two are probably fear of missing out, and greed. Now, just to break it down into a little bit more detail, buying, what happens when you take an action based on emotion and what the general results look like. First, buying on FOMO. I might as well bring this over so you guys can see. This is my note. Okay, maybe a little bit harder to see. First is buying on fear of missing out. It tends to lead to hope and regret. You're gonna be hoping that it's gonna be going up in your direction or down in your direction, and then when it doesn't, that's gonna be a regret. Why did you buy? Why did I buy? So I knew I was having FOMO. Why did I buy? That's buying on FOMO. Second, not selling in the money on greed, which leads to regret and bag holding. Right. So this means not selling while you're in the money, you're in the greens because you're greedy. That will lead to regret and holding that bag, hoping that it'll go back up. Third, selling on greed, leading to FOMO. What that means is you're selling, let's say typical you what's a daily chart here? You've caught this move, majority of this move, 12% on SPX index, and you're like, okay, this is great. My greed has been met. You sold here, you see it go down, you're very happy. It went down. Yes, you got it perfectly. Then it starts going back up again. Then that became regret of selling and fear of missing out, which then might lead you to incorrect decisions on buying up here, and you're just gonna start nailing the top kind of thing. And the fourth, not buying on emotions is the best case scenario. Or not even selling actually on emotions. Make sure you have your targets developed before you enter a trade. Whenever you take action based on emotions, they tend to lead to regret for either buying or selling, which tend to lead to further mistakes, and then it's just going to be a spiraling down kind of action. So when you're making a trade, if you're getting ready to make a trade, do a self-check. Are you emotional? Are you buying because you're emotional? Are you selling because you're emotional? Then don't. Step away. Go do something you enjoy. Relax a little bit. Don't make a trade based on emotions. Master those emotions. Be in control. Okay? Next, new topic. Second new topic. And this is going to be the last topic of this video. Video is... oh, not as long as I expected. Alright, so last topic is ticker behavior. And I don't think I've seen this topic anywhere on YouTube video. It's each individual tickers, each individual company, name, they tend to have their own behavior. And it's going to be hard to learn that behavior. Now you got to think of them as each company or ticker as a individual person. They're each going to have different personalities. To give you a few examples, Tesla. Tesla likes to give fake outs. From personal experience, it likes to give fake outs on the open. So let's take a look at a couple of charts here, or a couple days here. Fake out. Yeah, right. So first day, we gap up, and I believe we're gonna have to zoom in closer, but it came down. Then you start seeing going back up. So that's a fake out. Second, gap down, sold off, then we got bought up. So that's a fake out. Third, this doesn't count. This is not going to be one of them because it's gap up and ran. So beautiful, amazing. But then it got sold off. So this Tesla is actually one of the best market open plays that I've done multiple times. If at market open it gaps down, look for that RSI, look for that pivot, those divergences. Any of them show up, should provide a good scalp. That's Tesla, fake out on opens. Second, space. It's funny that on the note that I made here, space, what I named it or noted was likes to give back gains. Now if you look at first prime example, when they first ran 150%, that pop-up was blocked. No, 490%. It ran 490%, and then it gave 80% of that run back, which is equivalent to 370% of those gains back. Then again, it ran here, gave it back. Or even if you zoom in closer, ran, gave it back, ran, gave it back. Same with this one. Big run, gave it all back, came back down to the lows. This one, same idea. Big run, gave it back. Now, looking at the same idea coming into Tuesday, keep an eye on it. I'm anticipating, because of how space tend to their personality to be, I'm imagining it's gonna give it back again. So that's space personality. Now I'm going a bit too deep into each ticker. Anyways, So that's to give you a couple examples of what I mean by each ticker has their own personality. It's going to be hard to learn what their behaviors tend to be like until you trade it. It's hard to know and truly understand until you've tried a few times yourself. It's same with trading. You won't be able to master trading until you have traded. Most likely gonna blow up a couple accounts before you actually master it. Lessons are learned best from action. I've always been more so a person that likes to learn through actions. Hated textbooks. But yeah, so lessons are learned best through taking action. If you're afraid of what the ticker, not knowing what the ticker tend to do, a couple things you could do: look back at what the previous chart pattern looks like. What does it generally do? Run up, put down kind of thing. Get an understanding of it. Then if you're comfortable, maybe play with half sizing. If you're not, play with like a third sizing. But you have to trade it to learn it. Okay, I think, yeah, that's the last topic. So now it brings me to just basically a recap. Last but not least, wanted to ask a question. What came of your writing your rules down and game plans down on a sticky note? For those of you that have watched the part 1, did you follow through on writing your rules and game plans down on your sticky note and stick it somewhere? I still have one on my screen right now, actually a couple. And I have a daily morning read that every morning, if I'm not feeling confident, I'll pick it up, have a quick read. Rules that I should be sticking to. Are you guys doing that? Are you guys following that? It really helps. Make sure you follow through. And if you like the content that I'm putting out, make sure to hit that like and subscribe button. Thank you for watching the video. I will see you next time.